Seven-day losing streak on the Nasdaq Composite. It has been brutal over the last week. From New York City this morning, good morning, good morning. Looking for a bounce and getting a drop. We're down 0.2 on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, dollar dominance.
The strength of the dollar.
The strong dollar.
Unrelenting U.S. dollar strength.
What it really tells you is that it reflects the strength of the U.S. economy.
The U.S. economy is faring better than the rest of the world.
Compared to Europe, compared to emerging markets, compared to China.
Currency is a big, element here.
The dollar is particularly strong.
At some point in the first quarter of 2023, that U.S. dollar is going to peak.
Valuation is pretty stretched.
And when that happens and the U.S. dollar weakens,
I think it could turn quite quickly.
It's creating ripple effects across assets.
But in the short term, and again into Q4 particularly,
Europe is in big trouble.
The recession in Europe and the energy crisis that is brewing.
Europe and the UK is so utterly pernicious. It's so no-win.
I think the strong dollar is here to stay over the near term.
The dollar is going to be king for a good few months.
It's the king right now, that's for sure. Joining us now is BlackRock's Gargi Chaudhuri and TPW's Jay Pelosky. Gargi, let's start there. Is it too early to fade this dollar strength story?
Good morning, Jonathan. It's great to be here. It might be a bit too early. I think we're still going to see some more weakness, especially out of Europe, given the nat gas and energy crisis that's ongoing. That's obviously around the dollar story. It's not about rates. It's not about what the different central banks are doing. It's all about that safe haven. And on a year like this, when we haven't had positive performance in either equities or bonds, the dollar has been the best hedge. I think the end is near, though. I don't know whether it's this month or the next month. I do think the end is near. So for those investors that have been waiting on the sidelines to perhaps go into, for example, local currency EM debt, I do think we're about to get there, but perhaps a little too early as we continue to get some poor data and more unfortunate news on terms of energy out of Europe.
Gargi, the timing is questionable. Let's talk about the reason. What's the catalyst? Why do you think the end is near?
Well, number one, we've obviously seen this huge move already. The whole reason, or one of the big reasons for this move, was this idea that U.S. would be the best among some of the other DM economies that are obviously slowing down. So perhaps part of that has begun to get priced in. So part of that is just the pricing in. Was this thinking back to January of this year, this is exactly what we would have expected would happen if the U.S. was doing better than perhaps Europe, the UK, etc. So part of that is pricing. Another reason, I think, is that by the end of this year, we will see the Fed having done most of, or at least my view is that they'll have done most of the hiking that they're supposed to do. We've already fully priced for them to go about 75 for this meeting, 50, and then a 25. I think that's the end of that cycle. I doubt that they're going to go much higher than that. And that's another reason why we could see a stabilization in the U.S. dollar.
A dollar right now very close to 111 on the dollar index. Jordan Rochester over at Nomura making some headlines in the last week with some big calls on the euro and on sterling. He says this: the problem started in energy. It will end there. Everything else is pretty much noise for now. Expect euro dollar at 90 cents by year end, sterling at 106 by year end. Euro dollar right now 98.87, cable 114.28. Jay, you are the perfect guest to talk about this with. Europe. You think peak fear in terms of the European energy story is here? Is that it then for the euro story, for this sterling weakness we've seen over the last year?
Well, I don't know about sterling, John, because I think what we're seeing here is the downside of Brexit and the UK decision to go it alone. This is not a crisis where you want to be alone. Clearly, the EU is going to attack this from a regional basis, from a integration basis. It's too big for any one country. So no strong feelings on sterling. They're on their own. Good luck. On the euro, yes, I think we've already passed peak fear. John, we had Russia shut the Nord Stream 1 pipeline. They shut it. And what happened? Gas prices fell. They're off 35% from the high. We're done with the European gas crisis. And I do think that that means that the euro is going to strengthen from here. You are going to see the ECB raise probably 75 basis points. They're going to be raising rates more in 2023 than the Fed is, and that's going to provide strength for the euro. I think buying the euro here is, if you have a 6 to 12 month view, is a pretty attractive option.
Trade for the brave right now for some people. Jay, let's unpack some of that. I'll get to the ECB call in just a moment. You think we're done on the energy side. Some people might say, Jay, well, we haven't seen the blackouts yet. We expect we will. Other people might say, we're waiting for industry shutdowns in places like Germany through the winter. This could get a whole lot worse. Why do you think that might not be the case?
Because I think the markets are forward-looking. We've already thought about all that stuff. We've already discounted all of that. The biggest fear, the number one fear, was that Russia would shut off the gas. Now, thankfully, in a way, they've done it. And so we have faced the fear. And guess what? It's not all that horrible. Gas prices are going down, not up. If there was such a shortage of gas, John, even in the out months, and by the way, the forward contracts have not gone up as a result of the Russian shut-in either. So if there was a big fear of gas shortages coming over time, it would be manifested. And I don't think that's going to be the case. Instead, what we're seeing actually is Europe coming together again in a crisis. We're going to see the energy ministers meet on the 9th. They're going to come up with the EU-wide plan. They're going to cover this situation, and they're going to emerge stronger from it. I continue to be impressed by how Europe is dealing with the situation, again, virtually against all other opinion. And to me, this is really a signal that Europe is going to get its energy system in place. It's going to be out of the Russian clutches, and it's going to be a clean energy leader that is going to have a great opportunity to surprise people to the upside in the coming years. I'm continuing to be strategically on a 1, 3, 5 year basis. I think Europe is extremely attractive. 28 straight weeks of equity fund outflows, 12-month forward PE of 11.5 times versus 17 for the U.S. Earnings upgrades, John, more earnings upgrades in Europe than downgrades currently. Going forward for the rest of this year. There's a lot that is, relatively positive. If you like, markets that other people hate, if you like cheap markets, if you like things that are on a turn, I think we're about to see the peak of the dollar. The Fed raising rates 75 basis points next week. That's going to be it for the front loading. That's going to mark the dollar peak, and that's going to set off all sorts of asset allocation changes.
Gargi, I'm sure you're listening to this and itching to get in, so please jump in. My question to you would be, is it too early to look ahead to spring before we've even had winter in Europe?
So the one thing that I'd make, and obviously, there are some good points made around, we have already seen the shutdown of Nord Stream, and perhaps that was the biggest concern. But what we haven't seen so far is the severity of winter. And obviously, we all hope that it's going to turn out to be a pretty normal winter and the demand for energy will not be, 15, 20% above normal, but we just don't know. And we won't know that for some time, which is why I still think that obviously there's going to be a point at which, to the other guest's point, there's going to be a peak in the dollar. And perhaps you do want to get back into the euro. I just don't think that's yet. I mean, today we got the GDP print and we're still, obviously we know that's backward looking. We're still looking at very solid consumption out of European consumers. That's obviously not going to be the case as we look at data out for this quarter and the next. So I hope that it doesn't turn out to be this way, but unfortunately, it's still too early, especially on the weather front, which is obviously going to be a big driver on the demand for energy.
Futures right now down about 1/10%. The big story over the last couple of days, the dollar dominance. Euro dollar 98.89. We're down about 1/10% on that currency pair. Sterling 114.21. Taking a look at it is Taylor Riggs. Hi, Taylor.
Hey, John. And not only looking at cross currencies, but the correlation with real rates as well. I think really surprising. We are firmly out of sort of the negative territory and looking at at some big real yields that are rising 84 basis points or so here on the 10-year real yield, along with sort of that dollar strength that you've been talking really all morning about. I think the interesting cross-asset correlation continues to be then what happens within the equity markets. At the top, you mentioned NASDAQ now looking at 7 straight days of declines. Well, global equities are down now for about 9 straight days. That is the longest streak going back in about 11 years. You're really starting to see at least global equities roll over just a little bit as we think about some of that dollar strength underway. Finally, the further cross-asset correlations may be no surprise here, given that more traditional correlation that you see with dollar strength. You get commodities rolling over. Relay, that chart shows it when we think about the last 2 weeks.
Okay. Taylor, thank you. Gargi, I want to come to you on some comments from Tom Barkin over at the Richmond Fed and the FT. He said the destination and real rates in positive territory, and my intent would be to maintain them there until we're convinced that we've put inflation to bed. Gargi, you see opportunities in EM, and I just wonder how uncomfortable the real rate story and how determined this Fed is to keep them there, how uncomfortable that makes you.
Yeah, so we've definitely, we heard a very strong and clear message from Chair Powell in the end of August at the Jackson Hole. They're telling us that they really want to push back on any rate cuts in 2023. Fine, the market obviously repriced immediately. And what they're telling us, and it's not just obviously Powell, it's every other speaker that's spoken since then, they've united to tell us that rates are going to be higher for longer. But what that means to me, though, this higher for longer story, is that it's a good time to own carry. So if you are higher, if you reset, if the market's already priced that, so we're obviously already pricing in close to 3.8% on the Fed funds rate. Perhaps it goes a little bit higher than that. I don't think so. But even if we price in about close to 4%, and then if we stay there, I think that's a Fed telling you to own carry. And one of the highest conviction trades I have going into now to the end of the year is actually the front end of high quality credit. So looking at IGSB, which really gives you access to investment grade credit in the front end of the curve, earning close to 5%, that's the yield of dreams.
The yield of dreams. Jay, do you agree?
I've got one to top that. How about Asian high yield, which yields 9% in dollars and pays monthly? That's one of our favorites. We have many that we like. We like the pipelines AMLP, which has a yield of about 7% and gives you exposure to the energy side as well. But I just want to pick up on the point about opportunities in fixed income and particularly in emerging markets. We're actually getting more bullish on emerging markets in this environment. John, as you know, we've talked about it. We have a view of a high nominal growth world supported by a global capex boom to deal with the 3 C's of COVID, climate, and conflict. And we think emerging markets are going to be a big winner in that. And it's interesting to note, I just took a look before getting on the air here. Over the last month, EM has been a pretty significant outperformer, with the S&P down, as we know, about 5-6%. ACWI ex-US down about 6 or 7%. EM broadly down 4%. Brazil is flat. Southeast Asia down 2%. And the best performing fixed income instrument we've had over the last month is that Asian high yield ETF I mentioned. 30% China property, John. You read the headlines, you wouldn't touch China property with a 10-foot pole. Last month was the best month for China high yield in a decade. Best performance in a decade. So there's a tremendous gap between what you read and what the markets are doing in many instances. And we always like to let Mr. Market tell us rather than us try to tell Mr. Market.
Jay Pelosky, we'll talk more about Mr. Market in just a moment. Gargi Chaudhuri alongside us as well. Jay Pelosky, so constructive on the major issues that everyone else is very, very bearish about. I can tell you on crude right now, dropped below 85 for the first time since January. On WTI. Futures right now on the S&P down about 0.2%. Yields a little bit lower as well. With some movers, here's Abby.
John, let's start out with a stock that's moving in the opposite direction of futures and perhaps will turn the markets around. Maybe, of course, I'm talking about Apple, the big heavyweight to each of the indexes. This on their big product unveil day, up about 0.2%. It will be interesting to see how this stock trades. Typically, it does climb on the day when the new iPhone is revealed. And of course, there is a price hike expected. Pinterest up 4.1%, upgraded over at Wolf to outperform on improving fundamentals and positive catalysts despite an uncertain economy. United Airlines unchanged right now. They, of course, in a filing lifted their sales and margin outlook. Demand is stronger than expected. separately, they are threatening JFK if regulators fail to allow them to expand their schedule. And then finally, John, Peloton down 1.7%. This on another filing around the company updating the warnings, the treadmill, Tread Plus, unfortunate child death, and the consumer agencies saying that they gave insufficient warnings that perhaps there's going to be some sort of financial responsibility there, John.
Abby, thank you. A story no doubt we'll look at again through the day on Bloomberg TV and radio. Coming up, the EU considering radical measures to curb soaring energy prices.
We are now confronted with astronomical electricity prices for households and companies, and with an enormous market volatility. Therefore, we will put forward a set of 5 different immediate measures.
That conversation up next.
We are facing an extraordinary situation, not only because Russia is an unreliable supplier, as we have witnessed over the last days, weeks, months, but also because Russia is actively manipulating the gas market. We will propose a price cap on Russian gas. Here, the objective is we must cut Russia's revenues, which Putin uses to finance his atrocious war in Ukraine.
The EU unveiling emergency measures to ease soaring energy prices, including a price cap on non-gas power and on Russian gas. This after President Putin threatens to withhold oil and gas to any nation, capping Russian commodities. Team coverage starts right now with Will Kennedy and Javier Blas out of London. Will, first to you, sir. Can you walk me through the separate plans, what we're hearing from the UK and what you've heard from the Europeans?
So there's a 5-point plan for the European Union, which is going to be discussed at the meeting of energy ministers on Friday. It includes several measures, I think notably a price cap on power that's generated from non-gas sources, so nuclear, renewables, hydropower at 200 megawatts an hour. Obviously, that's still quite a high price by power by historical standards, but a lot lower than some of the prices we've seen. Also, stronger mandates on demand reduction, and a possible levy on fossil fuel companies. 2 other aspects which are interesting. First, liquidity support for the market. Now, I think that's important because if it's strong, it may stop some of these very volatile moves we've seen in gas and power in Europe. If people have confidence that governments are standing behind players in the market, and it may help smooth out some of the volatility. And finally, there's a cap on Russian gas. Now, that ultimately looks like the most headline-grabbing part of the package, but may prove to be one of the less significant parts because, as someone else pointed out earlier today, only 9% of Europe's gas is now coming from Russia after the Nord Stream pipeline was shut down.
That's an amazing drop-off from where it was before. Javier, one thing you've written about on Bloomberg Opinion repeatedly is curtailing demand destruction and rationing. Where's that in all of this, Javier?
Well, the European Union is putting a plan that it will mandate a 10 to 15% reduction in electricity demand across the continent. It's very unclear how that's going to happen. Certainly, with the measures that the European Union is announcing, the market is not going to longer be rationing the demand, and governments are going to have to do it. So mandates are going to have to be imposed. And I suppose that governments, at the end of the day, the big consumer of electricity in Europe everywhere is the industrial sector. Governments will have to tell industries when and what they can produce. That is going to be quite an interesting experiment to watch from outside. But that's where we are heading at the moment, because this plan of the European Union does not work unless you bring demand down.
Javier Blas, alongside Will Kennedy, to the both of you, thank you. Just looking at crude, drop away by 3% on Brent crude right now at 89.95. It's a break of 90 for the first time since February. A little bit earlier this morning, a break of 85 on WTI. Got that right now at 83.85. We're down 3.5% there. Final comment now from Gargi, Chaudhuri, Jay Pelosky. Jay, you're very constructive on the European story. I'm slightly more concerned about transferring risk to the sovereign with unlimited liability in places like the UK. You were very keen to separate the UK from Europe. Just in a couple of words, can you tell me, Jay, why you think the pain might be more acute in the United Kingdom as compared to the rest of the European continent?
Well, because they don't have the ability to come together and act collectively, as Ursula von der Leyen just did. I mean, John, here's the deal: after COVID and now with the energy crisis, the EU front and center in Europe acting collectively, and the euro is an expression of that. And therefore, seeing that action, two big deals, Europe is going to be transformed by this. And the euro is that expression. You can buy it at 99 cents on the dollar. It's a pretty attractive deal to me. On the UK front, it's by itself. It's going to struggle to deal with all these issues. It's in a place with very few friends, and therefore it's going to be more of a challenge and more difficult to see it work. When you ration demand, as Europe is going to do and is already doing, demand is falling rapidly in many parts of the continent. You're going to get a significant price shock, and most of what they're proposing probably isn't even going to have to be used, in my opinion.
Gargi, and a final word from you, a few final words. Can these central banks, the ECB and the Bank of England, keep hiking into this?
Honestly, it's going to be very difficult to realize what's been priced in the markets, especially for the ECB. So when we're looking at a peak rate of over 2%, I just don't see how they get there. Obviously, they're going to go 75 tomorrow, and they're probably going to get to 1.25 very quickly. But they're going to have to do this at the same time that they see the data really weakening in a meaningful manner and people suffering on the streets. I think it's going to be very hard for them to get much above that 1.25 to 1.5%. So not likely to realize what is currently in the price in the market, especially for Europe.
Gargi Chaudhuri, Jay Pelosky, to the two of you. Thank you. Jay, so constructive. You wanted a bull. There's a bull. Coming up, the morning calls, and later, Wells Fargo's Chris Harvey expecting stocks to move higher into year end. Another more constructive view around the opening bell coming up. 4 minutes away from the opening bell. Futures down by about 0.1% on the S&P. Here are your morning calls. First up, Wolf Research upgrading Pinterest to outperform, seeing significant long-term upside to both user growth and monetization. MKM Partners downgrading Electronic Arts to neutral, expecting shares to be range-bound with limited catalyst on the horizon. And finally, Macquarie upgrading Netflix to neutral, 230 price target, highlighting the company's strengthening ad sales projections. Coming up, Wells Fargo's Chris Harvey expecting stocks to move higher as investors shift back into growth. That conversation up next. The opening bell just around the corner. "24 seconds away from the opening bell this morning. Good morning to you all. This is the state of play right now, this Wednesday morning. Futures down about 0.1% on the S&P. On the Nasdaq 100, up by 0.2% on the Russell, down by about 0.2%. We're kind of going nowhere. Bit of a churn after 7 days of losses on the Nasdaq Composite. As the opening bell, switch on the board and get to the bond market. It's kind of like yesterday upside down. Yields are lower this time by 5 basis points to break at 330 again, 329.58. Euro dollar unchanged at about 99 cents. Sterling anything but unchanged, 114.32. Lower the session, 114.14 on cable. Right now down about 0.8% on the pound against the US dollar. Crude breaking down as well. We're down 4% here, $83 and about 50 cents on WTI. That's across asset price action with your movers at the open. Here's Abby.
John, let's start out with a big tech mover. And of course, I'm talking about Apple on their big product reveal day. That iPhone 14 will be coming out. And the stock right now up modestly, up about 0.2%. United Airlines popping higher, up about 0.7% in a filing. They did raise guidance for both sales and margin outlooks. Demand is strong there. And of course, earlier you were talking about how crude oil, WTI, broke below 85 for the first time since January. We have Brent crude below 90 on this. The energy complex is weaker, one of the worst sectors on the day. And interestingly, I don't know if we can pull up Tesla, but we do have a headline from Tesla that Elon Musk's request to push the Twitter trial back has been denied. I'm sure that there will be much more in this story as the day progresses, John.
Well, we can talk about it right now. Abby, thank you. We can get to San Francisco and catch up with Ed Ludlow for more. Ed, we'll talk about Apple in a moment. Your reaction to this headline, that Elon Musk's request to push the Twitter trial, it's been denied.
Yeah, I mean, it's not hugely surprising. The judge had said to both parties originally, look, go away and decide amongst yourselves which date you want to start the trial. Twitter had wanted to start earlier than October. Musk had originally pushed for next year, January or February. The date that they were targeting was October 17th. What Musk's team then said is they wanted to delay to December because they felt that Twitter were not forthcoming with specific information. In fact, the accusation from Musk's team was that Twitter was deliberately sitting on certain information, and therefore that Musk's team felt they couldn't possibly be ready for an October trial. In the end, this is the news. It's been set. It's been denied, his request to delay until December. So we're moving towards an October date, and I hope to be there in Delaware.
Talk to me about the relevance of this headline, then, Ed. Just build on this for us. He's allowed to use the Twitter whistleblower complaint in the trial. How important is that?
Yeah, so the whistleblower complaint, as Musk's team hoped to use it, was that this employee had knowledge or concerns about spam and bots on the platform. What Twitter's team told a court in the pre-trial hearing yesterday was that at the time of his employment, this employee never mentioned these issues to management while he was an employee. They said it was strange that the whistleblower would come out after the fact in the run-up to the hearing. So this is the crux of Musk's concern about his hesitancy to go through with his original $54.20 a share offer to buy Twitter, that the level of bots on the platform is not what he believed at the time he put in the bid. But Twitter have maintained all along that the level of bots is around 5% of all users. They've used that in boilerplate regulatory filing language for a long time. It will be an interesting point of discussion during the trial.
Ed, we've got to talk about Apple as well. New iPhone a little bit later.
Sure.
Slightly earlier, I'm told, Ed. What are you looking for?
Yeah, I mean, it's often the worst kept secret in technology, isn't it? Investors go into this event knowing basically what the lineup is, the iPhone 14 next generation. You look over history over the last decade on 7 occasions where Apple have released a new handset, the shares have gone down. There's nothing really to boost the stock here. What's really important for the street is the emphasis on higher price point, Pro models. Why? Because you look at that chart on your screen, the Bloomberg terminal, sales growth in the fiscal first quarter, the December quarter, which is the key Christmas period, set to grow by just 1% year on year. So the street hopes that this higher price point with the Pro models boosts that ASP, average selling price, and means that EPS growth will outpace that top-line growth. But really interesting, you know I'm a complete nerd for this stuff, John. We want the emphasis on the higher capability camera. We want to know if this is a tease from Apple. Go on Apple's Twitter and look at the logo for this event, the Far Out event. It's the Apple logo is a constellation of stars, and the inference we've taken from that is that we could see new satellite capabilities. Do you remember when you and I used to talk about the 5G supercycle?
Sure.
Now we're going to be talking about satellites.
So if this is if I'm stuck in the middle of nowhere with no signal, that I can still get signal.
Exactly.
Ed, is that right? Okay.
Exactly.
Ed, Kelly and I this morning were talking about the iPhone slowing down when the new iPhone comes out. Is there anything to that?
Yeah, I think that there's a risk with this, right? This higher price point strategy. The street cheers it if it can boost EPS growth, but it comes at a time where the global economy is suffering. You know, Apple has shown some resilience with the changing macro picture because it's relied on middle and higher income markets to boost sales. But inflation such as it is and consumer hesitancy such as it is around the world, there is no guarantee that those consumers will stay through the end of the year as they have done in the first half of this year.
Ed, thank you. I think you dodged the question there, but we appreciate it. You talked about something else. Ed Ludlow. Katie, you know what I'm talking about. Where's the poll on Twitter? Where are we?
More than 600 votes. 75% of people say, yeah, my phone slows down when the new one comes out. So.
Let's see if this slows down a little bit later. Kelly, I wanted to talk about Ed Clissold and Ned Davis. This is what he wrote this morning. With sentiment at extremes between retail and institutional investors, it leaves the market vulnerable to a pullback and a retest of the lows. That division between the bulls and bears is going nowhere.
Yeah, and usually we talk about the division on Wall Street itself, but there's also a noteworthy division between Wall Street and Main Street in that retail investors seem to be a lot more bullish than institutional investors are. What Ned Davis took a look at really is just short positions. The gap between the amount of net short contracts between retail and speculators is about 78,500. That is the widest going back to the April to June period of 2020, which noteworthy was not a bad time for stocks. It was right after the COVID market bottom, and historically the S&P has rallied sharply when large speculators speculators have been heavily short as they are now. But on the flip side, the speed in which retail optimism has picked up, Ned Davis says, usually means that stock market returns are flat when you get this optimistic this quickly. And as for the street itself, obviously, as we were just looking at there, as the S&P 500 has dropped 18% this year, those targets have come down from 49.50, the average target at the end of last year, to 43.76. as of August. But the pain hasn't necessarily been concentrated in the S&P 500 alone. It's much more in large cap technology, which is why the NASDAQ 100 is down 8.5% over the last month. The S&P Growth Index down about 7.5%. And what do those two indexes contain, John? A lot of tech stocks, which we know are among the favorites of hedge funds, which have felt a lot of pain this year as rates have gone up.
Kelly, thank you. Looking for a bounce, and maybe we've got one for now at least. We're up by 6 or 0.7% on the NASDAQ. On the S&P, up by 0.4%. One topic, you know what it is. Investors still searching for a bottom.
To the most volatile months of the year.
Historically and seasonally, September and October tend to be the most volatile times.
September and October are normally when you get markets going down sharply.
September's going to tell us a lot.
September tends to be the worst month.
A lot of companies throwing the towel for the year.
I wouldn't be surprised if equity markets go down a bit further from here.
The U.S. economy is going to continue to slow in coming months.
If we're going into recession, then likely the lows aren't in.
I've been looking for about 3,500, and the SPX is the rock bottom.
The market will bottom.
It's going to be much harder to identify a viable bottom.
And we think that's probably sometime between September and December.
Peter Cheer of Academy wrote to start the week, "Wake me up when September ends." Chris Harvey of Wells Fargo sees a better path into year-end, saying a retest of the lows may not come until the first half of 23. Chris, I'm pleased to say, joined us now. Chris, I think this is where we've got to start with you, and thanks for being with us, by the way, buddy. It's always great to catch up. That is your view, and it separates you from the big bears out there, that the weakness that they're looking for in earnings at the end of this year, you don't think comes until the beginning, the front half of 2023. What's the difference between you and them, Chris? How do you get there?
Yeah, so we get there a couple ways. John, let's kind of roll back the clock, right? So in the summertime, we talked about 4,300 being the high, the big risk being interest rates. Interest rates could move higher. Well, interest rates did move higher. But what's notable about interest rates moving higher is it looks like European rates pulled U.S. rates higher. And why did European rates go higher? Well, it was because of inflation, but really bad decision around energy and energy policy. So stocks are down because of bad decisions over in Europe. Does that make a whole lot of sense to you? It doesn't to me, right? And at the end of the day, what we need to see, if you're going to get stock to retest the low, you have to start seeing the pre-announcements over the next couple days, the next couple weeks. If you don't see those pre-announcements, I don't see us retesting the lows. And I have a few more thoughts, but let me stop there, see which direction you want to go in.
Well, Chris, let me pick up on what you've been talking about in your notes, and that's corporate outreach, the roadshows, the conferences. Yeah. You say that outreach hasn't diminished. What's the signal there, and what typically is the correlation between what happens there and what happens with the market?
John, that's perfect. So in the summertime, the head of our corporate access came to me and said, Chris, one of the things we're not seeing is we're not seeing the corporate retrench. They still want to do non-deal roadshows. They still want to go out to conferences. And what the head of our corporate access said to me is typically when the economy slows down, that's not something that you see. What they want to do is they want to go back home. They want to take care of business, or they really don't want to talk to the street because there's not much to talk about. And the conference season is packed this year. And we view that as a very strong signal. We also view the fact that the Fed is likely to decelerate after this meeting, and that's a very good positive for equities. So there's a lot out there. And as you point out, and as you highlighted, sentiment is very, very poor. Everyone is waiting for the next shoe to drop. Everyone thinks everything's going to fall apart right here, right now. And we think the first half of next year is going to be difficult. But you've pulled ahead a little bit too much risk and a little too much doom and gloom.
So, Chris, let's talk about what's worked and whether you'd lean the other way. One thing you talk about in some of your research is this long software trade, very defensive, short semis, highly cyclical, and how that's worked well. Are you thinking about leaning in the other direction?
Yeah, John, that's worked really well. That's a consensus trade. We are underweight software. We've been underweight software for some time, just against the broader market, not against semis. But it looks like it's too consensus at this point in time. It looks like a lot of the bad news around cyclicals, especially semis, is really priced in. And I could see that trade going the other way sometime between now and year end. So what we're telling clients is, hey, it's working, it's great, but we'll be looking for an out, or be looking to take some profits on that trade.
Chris, Brent and WTI down hard today, off by 4% on crude to 83.40 on WTI. Brent crude to break a 90. So we're really rolling over here. And as you know, the energy winners have been the winners of this year. Right. Any idea about what you want to do with that now?
Yeah, John, we touched on this the last time I was on the show. Energy is a place that we like longer term. It's not a place that we really like right here, right now. We would, if the market or if the stocks do pull back, the stocks have been a little bit volatile. If they pull back in a significant way, we find a lot of quality, we find a lot of value, and we think that energy policy is going to keep supplies pretty constrained. And so the longer term picture is very good. But right here, right now, that's not a place that we would really want to delve into. We do like that growth at a reasonable price type stock, and that's where we want to place our bets.
Chris, final question for you. Nasdaq Composite before today, 7 days of losses, down close to 8-9 percentage points over that time frame. For the passive investors out there looking at that index, the Nasdaq 100 to be precise, what would you do with it, Chris? What would your advice to them be?
Yeah, John, that's a good question, because we don't look at the NASDAQ explicitly, right? We generally look at the different sectors, we look at the different stocks, and what we would say is, if you can find stocks, and there are plenty of large cap stocks, and there are plenty of growth stocks that are trading at reasonable prices, that's the portfolio that we want longer term. That's where we want to place our bets. As far as the market overall, we do think you're setting up for an oversold bounce, which includes the NASDAQ. But if you're building a portfolio, really look for those reasonably priced growth stocks, because the economy is slowing down, inflation is coming off the boil, and there was a massive derating in the first half of this year, which has uncovered, funny enough, a lot of value in the growth space.
Chris Harvey of Wells Fargo. Chris, appreciate it, sir. As always, working through some of these issues. Right now, about 13 minutes into the session, equities positive 0.4% on the Nasdaq, up about 0.75%. We'll catch up with Mike McKee next to go through what's coming up through the day ahead, including a ton of Fed speak as well. From New York, this is Bloomberg.
Just another shock hitting the global economy. And of course, from the China perspective, it's not surprising that growth is so weak, because there is no consumption engine to drive growth. And also you have the slowdown in the rest of the world. And so you cannot grow just based on your exports. Growth is likely to remain slow until something turns.
China's export growth slowing more than expected in August. This coming as dollar strength continues weighing on the yuan, extending its decline and inching closer and closer to a 7 handle. Joining us now is Mike McKee and Taylor Riggs. Mike McKee, that data in China not looking great.
No, people are beginning to suspect that things are worse in China than the Chinese are letting on, but they don't want to say anything until the Party Congress is over next month. The trade figures, pretty dismal. Exports up just 7.1% in the month of August. That is less than half of what the July figure was. Imports up 3.8%. So both of those slowing significantly. Some of this is base effects, but they also get a boost from a stronger dollar. So it is worse than it appears just in that chart there. And it is having an effect throughout Asia. You take a look at what's been happening with imports to China from countries like South Korea, which sends in material to be assembled, like Australia, which sends in raw materials, and those countries are selling a lot less to the Chinese right now. The United States and the EU also seeing the impacts. The shipments to trading partners in the U.S. were down 3.8%. That's the first time in 26 months that we've seen a decline. Europe also down a little bit as well. And given the European economy, not selling to China is not good news for them. So this is just another in the latest of a number of signals that say China, on the back of COVID-0 and declining global demand, is having some real problems now.
699.71 high this session on dollar China. Taylor, we got this far away.
And that's right. When you point out sort of the key 7 per dollar level, of course, that is under focus. You're getting a little bit of some movement here, to Mike's point, a little bit in the yuan. So we're taking a look at trying to get up some strength, but really not moving the needle. This, John, of course, comes if you change up the board, what has been 11 straight days of stronger than expected fixings. Think of this as the PBOC really coming in to try to support the currency, setting some of these key levels. But frankly, it's not really doing much here to move the needle. So this certainly has been something that we're watching when we think about some of the emerging markets, some of the other Asian currencies as well. And that leads me to my next point, John, because this hasn't just been stronger dollar yuan weakness. This has also been, to the bottom of the screen there, a lot about the yen as well. Some big dollar strength relative to yen weakness. There's a strategist over at NatWest Market saying that there's been regional momentum, other positioning factors in play after the yen broke that key psychological level of 140. So you're really getting some of these technicals as well coming into play.
10% move year to date. It's quite a move. Taylor, thank you. Looking forward to the close a little bit later with Taylor Riggs, Romain Bostic and Caroline Hyde. Your equity market about 20 minutes into the session, firmer by 0.5%. Nasdaq bouncing back up 0.8% with your sector price action. Here's Abby.
Hey, John. Well, yes, we do have gains for the S&P 500. It's the first or second update, I should say, in 8 days. So a bit of a reprieve for the bulls. And most sectors at this point are higher. The best stock on the day, Apple. So not surprisingly, tech is one of the top sectors. The top sector, though, interestingly, is yesterday's top sector, utilities, up 1.7%. Today, it's a little bit more justified from a yield standpoint. Yields are down, so the dividends look a little bit better. But as you know, this is a defensive sector, so we are leading this charge today with defense. Right below it, though, consumer discretionary being led by Tesla, interestingly, and then communication services being led by Twitter. Both of those stocks are higher. But the worst sector, as you know, energy down 2.5%. This, of course, is crude oil. WTI has broken $85 per barrel. It's at its lowest level since January. We also have Brent crude back below 90. Some of the big laggards on the day, not surprisingly, are some of those energy movers, including ExxonMobil, along with Devon and Halliburton. A rough day for energy, and it's going to be interesting to see whether this top sector on the year this year and last year, if it can stay in this place, if crude oil does in fact continue to slide on that strong dollar.
Abby, thank you. Your trading diary up next.
Certainly energy security has elevated its position, and certainly we're going through a transition. We have to do it more sustainably. And I think they're struggling with how to write the right policy to encourage early time investment, yet figure out how they want to go through the transition. And some of what they're talking about with excess profits tax, it's going to have the unintended consequence of reducing supply long term.
Whatever we do, one thing is for sure, we have to save electricity, but we have to save it in a smart way. If you look at the costs of electricity, there are peak demands. And this is what is expensive, because in these peak demands, the expensive gas comes into the market.
What we need to do is increase our energy supplies long term. And that is why we will open up more supply in the North Sea, which the Honourable Gentleman has opposed. That is why we will build more nuclear power stations, which the Labour Party didn't do when they were in office. And that is why we will get on with delivering the supply as well as helping people through the winter.
It is the #1 issue in the world right now. It's what happens with energy. I can tell you the good news stateside is that crude is rolling over. Both Brent crude and WTI and equities are bouncing back by 1/3% on the S&P 500. On the Nasdaq, up by about 0.6%. On the Russell, 25 minutes in, up by about 1/3%. That's the price action. Here's your trading diary. A rate decision from the Bank of Canada coming at the top of the hour. We'll also get the Fed's beige book and Fed speak from Mester, Brainerd and Barr, all on the agenda. An ECB rate decision coming up on Thursday, followed by President Christine Lagarde's news conference. Plus, at the same time, we have a news conference from the ECB. You'll hear from Chair Powell delivering remarks from Washington, D.C. And finally, more Fed speak to close out the week with Evans, Waller and Esther George. From New York City, for our audience worldwide, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.